Welcome to Gas Station Business 101 podcast. I'm your host, Shabir Hussain, and this is episode number 21.
Welcome to the one and only Gas Station Business 101 podcast, where you can learn all the secrets about how to start and operate a gas station business successfully and make money. This podcast is brought to you by the good folks at CSB Academy Publishing Company. And now, here is your host, Shabir Hussain.
Hello there. Welcome to episode number 21. Today, the topic is how to create effective working partnership to grow your business. You may be confused because last episode we spoke about how you can find investors or partners that can invest in your business when you're short on cash. Remember? Well, today's episode is a little bit different, but just to remind you, because it has been a couple of weeks since I published the last episode. On last episode, we talked about if you're short on cash but willing to do the hard work, then there are ways you can get into that dream business of yours and start a small business such as a gas station, convenience stores, or any other business, as long as you're honest, dependable, hardworking, and willing to do that hard work. There are people out there that will invest with you. Because there are people out there that do have the money but don't have any other resources or the time to start a business. And everybody is looking for a second or a third income. So for you to capitalize on that, I outlined a way you can get that partnership going or get that investor to invest in your business where it becomes profitable for both of you. Because if you work hard, you will make profit out of that business. So along with your salary, you can share profit with your partners. But today, I want to flip the coin where we're going to talk about what if you are already in business, which most of us are, but what if we want to grow? What if we want to have multiple businesses? So again, this time you were looking to get a second or a third income from a second, third, or fourth business, but you're short on manpower and other resources. What if that is the case? So again, last week we spoke about 3 ways you can get people to invest with you. If you recall, those were crowdfunding, partnership, and getting investors. But today, as I said, I want to focus on the flip side of it. And in this case, we're going to be talking about working partnership versus silent partnership. And what if you can get multiple partnership with one key operating person, and how all these can benefit you to grow your business? Now, depending on your situation, one of these should work for you. Again, from last week's episode, I only talked about what if you don't have the money to start your dream business. And if that is the case, then I assume you're willing to do that hard work and operate a business and make it profitable. And as I said, share the profit with your partners or investors. But one important thing to remember on that, as I mentioned before, transparency is the key to any partnership's success. If you're the key operating person, as I mentioned last week, make sure you have a good CPA or an accountant that can provide timely sales and P&L and all other financial reporting to you and to all your partners or investors, so they can stay up to date as far as what is taking place in the business. Similarly, when you're looking to grow, you'll be expecting the same, I would imagine. You would want the same type of reporting furnished to you at a timely manner every month or every quarter, however way you set it up with your partners. But let's jump right in and let's talk about there are 3 ways you can go about doing that. Just like last time, number 1 in this case would be get a working partner. Number 2 would be get a equal partner. And number 3, get multiple partners with one key operating person. And I'm going to explain each and every one of these. So let's get down and get with the first one, which is how to get a working partner. And what is a working partner? At first, the word working partner can be a little bit confusing, because what is a working partner as opposed to a non-working partner? But in reality, working partner is somebody who's willing to do the work in the business, as opposed to being silent or non-active. So in your case, since I assume you have the funds and you're looking to invest in a similar business that you already have, you're looking for a partner that can contribute their hours, their effort, and their willingness to work in that business to make that business a successful operation and a profitable one. So in this case, they may be short on funds, but they're looking to work to make up for it. So let's say you found a business that, let's say, ballpark figure that cost $100,000. And you found a person that has, let's say, $20,000 to invest. And in your case, you're not looking for that money, but you're looking for a partner that wants to operate the business, somewhat like a key operating person. But at the same token, remember this, if you get a partner who did not invest a dime in a business, if they don't have any skin in the game, so to speak, that means they may not value the business as hardly as you would, because your money is invested in that business. So the best scenario for me and for you would be, whatever money they have, take that into the business and say, listen, even though you invested $20,000, but I'll still give you 50% partnership as long as you pay me back the other $30,000 from your profit every month. I've done it before and it works wonderfully. Always remember, whoever you get involved in your business, they have to have a somewhat of a skin in the game. Again, when I say skin in the game, means they have to have some type of investment tied to the business. If not, one bright morning, they can wake up and say, I got a better opportunity, so I need to get out of here. And they can leave your business and put you in a lot of trouble. So it is a good idea, because you're not looking for a manager. You're not hiring a manager. You're getting a partner. And in order for you to have a successful partnership, it is vital that that person has some invested interest in your business. This way, they will value the business as much as you do, if not more, because that is the business that feeds their family. This is the business that pays their paycheck. So, as I said, when you find a suitable partner, he or she may not have all the capital. Again, if your business cost $100,000 to buy, again, it's just a ballpark figure, and you're looking for an equal partner, which is a 50%, then that person needs to invest $50,000. But for example, if he or she only has $15,000 or $20,000, then what do? You say, okay, invest that money, and the difference, which is their share should be $50,000, but if they only have 20, so they're short by $30,000. So what you can offer is, every month when you do the P&L, and let's say the profit comes $6,000 next month or 1 month, and you guys should share $3,000 and $3,000. So instead of him getting the whole $3,000, he should pay you that $3,000 or $2,000 every month until that balance is paid off. But again, you don't have to offer them 50%. I have seen where people say, okay, I'm taking a working partnership where they will offer 25% of the business plus a salary. So in that event, their investment should be only $25,000, because again, if we are taking that $100,000 cost for the business, 25% shares should only cost $25,000. And if that person has $25,000, that's great. If he or she does not, then they can pay you back over time, monthly, from that profit until they're paid off their $25,000. But again, it is a good idea to drop some sort of paperwork that explains that they will be paying you off, maybe without any interest or anything, just a monthly payment to pay off your invested money that you invested on their behalf. Because if they had that money, you wouldn't have had to come up with all the money. So I hope I made it clear. So working partnership can work in different ways. It doesn't have to be 50-50. It can be 20-80, 25-75. I mean, whichever way you want to structure it, as long as you have a clear understanding with that other person that this is how it will work. And you can do some future projected P&L that shows, okay, I'm looking at this business. It should generate about $4,000 to $6,000 profit every month after all the bills and everything else is paid off. Net profit should be about $6,000 or $5,000, whatever it is. I want you to pay me X amount of dollars every month out of that, your share of profit, so your loan can be paid off in some sort of predetermined time, let's say 3 months or 6 months, depending on the balance and the expected profitability of that business. But as long as you have it written down, I think you will be in good shape. But before I go to next step, which is talk about the second part where we're going to talk about equal partnership, or third, which is multiple partnership with one key operating person, I want to explain something about partnership. And there are some key characteristics that I want everybody to understand what partnership usually is all about. And I'm sure most of you already know this, but I just want to re-emphasize on what partnership characteristics are. Number one would be all the partners have some sort of potential stake in the partnership, meaning every partner should have some stake, some skin on the game, like I was talking about before. And you see, that is why I'm mentioning the characteristics now, because I already explained that every partner should have some skin in the game, some type of invested interest in the game. If not, they will not value the business as much as you do. Number two, all partners are working towards a common goal, meaning every partner's goal should be the same, where to make the business a success. Number three, all the partners have a similar ethics or system of beliefs, meaning your system, your ethics should be similar to your partner. If one partner is not as ethical as the rest of them, then there is a potential problem. If one says, I don't need P&L, or you don't have to do P&L, save that money, you do it, or let me do it, and whatever and whatnot, cutting shortcuts on things of that nature. Meaning, when in your absence, things can go wrong and you would not know because it's not done properly. So everybody has to be on the same page. Everybody's ethics has to be high, and the belief system has to be there that this is our business and our main goal is to make this business a success. Number four, all the partners work together over a reasonable period of time. Meaning, if every partner understands that this is a business that, let's say you're buying a business that takes 3 to 4 months to be profitable. Not every business makes money from the day one. There are some business that needs to be built up to that profitability. So as long as everybody is in that same page and understanding that it requires time to build that business up. Or, for example, one partner shows up on 15th of the month and says, I want my profit now. Well, when you created that partnership, you made it clear that after the month ends, all the paperwork and the sales reports go to a CPA or an accountant, and within 10-15 days, they process that information, they send you guys a report, and then you do a distribution from your checking account, not your checking account, the business checking account. You distribute profit. And again, once you distribute that profit, you need to make sure that you notify your accountant that this is the profit I distributed to our partners. So at the end of the year, the accountant can serve a form called K1 in case you're doing partnership from an S Corp or an LLC, they get served a form IRS recognized as a K-1. But again, a partner cannot show up in the middle of the month and ask for their share of the profit in advance. See, that is where a potential partnership breakdown can start. And in that note, I want everybody to understand that everybody needs to be on the same page as far as not only ethics or honesty, has to be the timing of how the business works. So everybody needs to be on that page that once the month ends, this is how long this takes and this is how long it will be to distribute profit. And number 5, there is an understanding of the value of what each partner can contribute or bring to the business. Let's say one partner is good with accounting. Another partner is good with merchandising. Another partner is good with advertising. Every partner can bring their best that they can offer to the business and make that business a successful one. Let's say in the event that you have a key operating person and the rest of the partners are silent or semi-silent. But let's say the silent ones, one of them is very good with merchandising, another one is very good with marketing. Then why not ask them to step in for time being and help the business out so it can grow and make more money? Some of these partners can say, well, I didn't invest to work. Well, you're not working. You're growing your business. And it's not going to be where you're going to be doing this every day, every month, every year. At the startup, you can come and show your expertise and improve that business. Number 6, there has to be a respect and trust between the partners. And I believe I touched on this many, many times. Without this two, without the respect, without the trust, no partnership will ever work for the long haul. It may work for 5 months, for 6 months to a year, but it will never have enough time to grow the business where it is profitable. So it is vital when you find or look for partners to understand that they have the same ethics and belief system as you do, and you can trust them like they can trust you, and you have the respect for that individual or that group of people, and vice versa. Just remember, partnerships are only successful because you share creativity, risk, responsibility, and resources. And all the participants in partnerships are able to feed from each other's energy and enthusiasm. You can gain from each other's strength and not from weaknesses, as there is more chances for productivity and efficiency. Service delivery is often more effective, and they offer support and diversity. So just remember these points. It's united we stand, divided we fall, pretty much in that mentality. That means you gain from each other's strength and not draw from the weaknesses. Okay, moving on to the second part of today's episode. First one, as we just spoke about, which is get a working partner. Next, get an equal partner. Well, equal partner is just as it sounds, meaning you're equal, meaning you're sharing the same responsibility. Well, I take that back, not same responsibility, but equal share of responsibilities along with same equal partnership, for example. So let's say you own a business and you operate that yourself, and now you want to invest in a second business. You have limited time available to invest in that business along with limited funds and resources. And you found a similar minded person who has another store that they operate themselves, and they too have limited funds and resources available. So what you can do is partner with that individual and say, listen, we will create a partnership where we're equal in every sense of the way. And we will share responsibilities for the store, and we will invest equal amount of money. So again, if we talk about the $100,000 investment, you're looking to invest 50,000 and the other individual will invest the equal amount, which is 50,000. And then the biggest part comes in is how to operate that business, who will take what responsibility. Because as you, I'm sure, know, that it takes a lot to run a business effectively and properly. So it is a good idea before you get into that business to sit down with this individual and draw it up or write it all down, who shares what responsibility. For example, who will make the schedule, who will hire employees, who will discipline them, who will order products, who will handle vendors, who will do the banking, who will do the bookkeeping, and all sorts of things. So if you know that you have a strength when it comes to dealing with employees and merchandising the store, you can say, I will take those responsibilities. But keep in mind, there cannot be two bosses in one business. So when it comes to employees, they have to know the chain of command. So if you're handling that, make sure you call a meeting of the employees and let them know how this chain of command works. Always remember, if you have two bosses or multiple bosses or authority figures in your business, the employees will always try to take advantage of that by doing similar things, like they will say, he told me to do this, by overriding what you have told them to do. So they try to take advantage of that. I believe that is the human nature. So it is a good idea to set that chain of command. In our business, the way I set it is, if one of my partner is responsible for operating that store, even though let's say I'm equal partner in that business, I always let employees know that if they need a day off, if they need change of scheduling, if they need a raise, any other concern they have to talk to the boss of that business, which I am not. Let's say I'm there every day. I'm doing merchandising, I'm doing vendor controlling, but still I do not get involved in that part of the business. As long as you make that clear to your employees, they will understand the chain of command and they will learn to respect that. So it is vital. I've seen many businesses fall apart because of this. And then the partners start fighting, saying, I told him to do this. Why did you tell them to do something different? So it is silly mistakes and confusion that you can eliminate just by making things clear. For example, again, if you're responsible for handling the vendors, for doing the orders and merchandising the store, as long as you do your job properly, then just let your partner do the other half. And they can do the deposit, they can do the employee control and whatever and whatnot. But again, you have to remember, you have to feed from each other's strength and not weaknesses. Also, you have to support each other. So for example, if your partner says, hey, I'm going out of town for 3 days, I want you to handle everything, just make it clear that yes, you will handle it, as long as they notify the employees that he will be out, so you will be in charge. And then you will act as full manager, full in control, in charge person. So then you can authorize a person to get a day off or change the schedule and whatever and whatnot, because they all know and you know that you are the person in charge. But do not override your partner's decision. And similarly, you wouldn't expect for them to override what you have done and your job responsibilities and duties. So if you're telling your vendor that you will take a special on something of 100 case of Coke or something, and then your partner comes in and says, no, we don't want that, just give us 20 cases instead, that creates a confusion, that creates a problem with your vendor's relationship and trust, more importantly. So as long as you can lay it all down in a piece of paper, that this is how it will be handled, as long as we go that way, we will be fine. But as I said, there are going to be times where one of you may go to the other one and say, listen, I can't handle my job for next 3 days because I have issues or family emergencies or whatever and whatnot. So please handle my job in next 3 days. And I will do so when you go out. And similarly, it's again, it's an understanding that you have to have. It's a type of bonding, friendship, respect, and some type of, what should I call it, dependency that you have to have with your partner. And it's just not a business relationship. You have to build it to be a little bit more than just a partnership. But again, I don't want you to be the best buddies with him or her and whatnot. There has to be a fine line, because once you get into their personal life, they get into your personal life, that can create friction. And again, that's not good for business. So as long as you keep a fine line in between and still have a good understanding, respect, and trust, it should work fine. Now, the third element, the last one, is get multiple partners with one key operating person. And I believe I touched on it briefly in the previous episode, but I will do it again. As I said, this is the flip side of what we talked about last time. So again, let's say you have a business or two that you operate. And again, you have resources and funds, but not enough time to operate another business. But you're still looking to increase your income. And you find 3 or 4 similar-minded people that are looking to invest but do not want to get involved in day-to-day operation of a business, but everybody's goal is to increase their income. In that case, best thing to do is find a good, trusting, hardworking, honest person that is looking to get into business but do not have the funds. And then you find a business, you buy that, make that person a partner, let them run the store. And that is called key operating person. It is a working partnership. Don't get me wrong. It is working partnership, but with multiple partners that are not involved in day-to-day business of that entity. So again, before you do this, you need to sit down with that individual and all your partners. Make sure you write an operating agreement that spells out A to Z everything, how the business is supposed to be operating, how the reporting should be done, how the merchandise should be ordered, how to handle employees, what will be the budget operating expenses for that business, and what is your expected profitability for that store. So you have a clear picture from day one as to how the P&L should look come next month or next year. As long as you have a clear understanding of what the business is doing now versus once you do some improvement, how the business would look in future. So again, projected P&Ls can be done 2 ways. One is based on the current sales that it is doing now. And then one would be where you do different improvements. For example, let's say the business doesn't carry a certain type of product which you think will do well in that neighborhood. And you say, I will merchandise the store with certain type of products and this will increase our sales. You can predict that sales, let's say, will go up by 3% or 2% or 5%. And then I will lower some tobacco prices or cigarette prices, be more competitive. That way I will gain another 3% of market share and all that. And then you say, my forecast for 3 months down the road should be this, X amount of dollars, versus if the sale remains the same, should be Y amount of dollar. So again, when you were expecting a profit, let's say 3 months down the road, you know that profit has to be between X and Y because one is based on current sales. So if you have not done anything to that business, and provided the business has not gone down since you take over, which you should not because you're qualified and you're experienced, hopefully, and the person you're taking in is experienced enough to know how to operate a business, so they will not harm the business and lose sales and have the business go down the road or downhill, then you know that if you have not changed anything in that business should make X amount of dollars in profit. But again, if you do few changes, it may do more, which is Y amount of dollars in sales. So 3 months down the road, it should be between X and Y. Let's say you projected that if it runs the same, you will make $4,000 profit at the end of the month. And if you make the improvements, it will do $6,000 a month. So come 3 months down the road, you know it should be between 4 and 6. And it shouldn't be 3, it shouldn't be 2. And surprisingly, it shouldn't be 10. I mean, if it is, then you did really a good job. But these are the things you need to make clear before you get into that business. That way, 3 months down the road, one of your silent partners do not call a meeting and tell everybody, hey, I was expecting to get $5,000 checks, but I didn't get more than 500. So what's going on? As long as you have a clear understanding on how the business will operate and profit in the future. Time to move on to answering some emails. But before we do that, I have a humble request to you out there, to all my listeners. If you like this show that I'm doing, I would appreciate if you go to iTunes or wherever you get this episode from and give me a review, an honest review. And if you want me to cover something that I have not covered, you can always go to my site, which is www.gasstationbusiness101.com, and ask me a question or send me an email from there. Now, as far as email, I have received numerous, I would say more than 5, less than 10 emails in last month and a half about EMV update. And I believe I mentioned briefly about this update in few episodes back. But what I have decided is there are so many questions that I've received that I'm not going to be able to answer all of that in an episode just by answering email. Instead, what I've decided is I will have an episode dedicated to EMV update, which will be the next episode. So please stay tuned for all of you out there that ask me about EMV update. You will have all those answers in the next episode. And now, as far as recommending a book, which I do in every episode, and this week it will be a little bit different, I have decided to recommend a TV show instead, a book. And this TV show is on CNBC. The show is called The Prophet, and it's done by a gentleman named Marcus Lemonis. And this is an awesome show, and I have learned a lot from that show. And I'm sure as a business owner, you will love the show and you will enjoy and learn a lot of things about retail and other type of businesses that are out there. And this is pretty much an eye-opening thing for me, that there are more businesses out there instead of just the retail mom and pop shops. So I'm sure if you watch this show, it will open up your mind and make you a little bit more creative, pretty much like thinking outside the box. And I'm sure you will enjoy it, as it is a very entertaining show. So with that, you can, if you need to see anything that we talked about in this episode, you can always go to my site and go under the tab podcast, and you will see all the show notes there. And you can also play the episode directly from that site just by hitting the play button. Hopefully, I will see you in next episode with those questions that I will be answering in all about EMV updates. So please stay tuned, and I will see you in the next episode. Take care.
This has been the one and only Gas Station Business 101 podcast with your host, Shabir Hossein. This podcast was brought to you by CSB Academy Publishing Company. Be sure to join us next time as we share with you the secrets about how to start and operate a gas station business successfully and make money.